Well, good morning, everyone, and welcome to the third installment of Anders' 2025 Banking Webinar Series. And for those of you who are new to us, a very special welcome. We do these on about a quarterly basis. My name is Brad Stumpy. I'm a partner and the practice leader for compliance and loan review services here at Anders. I'll be joined today by Sadie Carrera. Can you please wave to everyone, Sadie? And Josh Labadie, who are both former bankers and both have many years of experience in the industry. Sadie is a CRCM and specializes in loan compliance, while Josh is a CAMS and a CBAP and specializes in both BSA AML compliance and in deposit ops compliance. So joining us off camera to answer questions will be Brenda Hall and Jessica Likey, also both former bankers. Brenda has successfully completed the Graduate School of Banking and specializes in BSA AML and deposit ops compliance, while Jess specializes in loan compliance. So now that everyone has been introduced, and before we get too far into this, I want to point out that you can download the slides from the chat if you'd like to have them handy during the webinar. They are also provided with an email that we sent out earlier this morning. So if you have the slides from the email, they are the same as those in the chat. They'll also be included with the post-webinar materials. So 3 ways to get the slides. Outstanding. If you have any technical issues throughout the webinar, you can also drop those in the chat, but those are the only 2 things we'll use the chat for today, are the slides and any technical issues you might have. Typically, we like to focus on something new in the world of banking, particularly bank compliance, but all of those new rules that we've been focusing on for the past few years have, some maybe have gone away, others have been put on hold. So we thought that today we discuss common violations and consumer complaints. And thus, we have the title for today's webinar, Bank on Compliance, avoiding the most common violations. So over the summer, both the FDIC and the Federal Reserve released summaries of their most common violations and consumer complaints. So we used those as a basis for today's webinar, and we'll sprinkle in some comments about what we commonly see as we make the rounds with our clients. We have over 200 registrants today, so very good. Thank you all very much for that. I'm glad you decided to spend part of your day with us. But that does mean that you're all muted and unfortunately won't be able to unmute to ask questions. But Jess and Brenda will be in the Q&A, so please submit your questions through the Q&A feature. You'll see that at the top of your screen and not through the chat. The only use of the chat feature today, again, will be for you to download the slides if need be, or if you have some technical problems. Before we get started, I will steal a little bit of Brenda and Jess's thunder. The first 6, 7, 8, maybe even 20 questions are always, will we have access to a recording of the webinar? And the answer to that is, yes, you will. In the coming days, we'll send out a follow-up email that includes a link to the recording. This slide, if we can move the slides forward, this slide and the next include the 8 primary areas that we'll cover today. So if something doesn't directly relate to you, hang in there for a few minutes and we should get to something that does. There were several similarities between the lists published by the 2 agencies, which you can find in the July 2025 edition of the FDIC's Consumer Compliance Supervisory Highlights, and then also the first 2025 issue of the Federal Reserve's Consumer Compliance Outlook. I'll kick things off by discussing common HMDA and CRA reporting violations, and then hand it off to Sadie, who will cover common truth in lending and flood insurance violations, and she'll wrap up her portion of the presentation discussing disputed information on credit reports, which was a top complaint received by both agencies, coming in at the top spot for the FDIC, and I believe at number 5 for the Federal Reserve. Josh will then come in and discuss common violations with truth and savings disclosures and EFT disputes. And I'll then jump back in to discuss another top complaint under the Fair Credit Reporting Act, which is identity theft, and wrap things up. One last quick note before we get started. While violations regarding identity theft, which I'll discuss, and information reported to consumer reporting agencies, which Sadie will discuss, and which is often referred to as the accuracy and integrity provisions of Fair Credit Reporting, violations of these provisions were not identified by either agency as one of their top violations. But both of these issues have been in the press a lot lately, ranked high in the areas for which consumers are filing complaints, so we thought it might be a good idea to include them. All right, enough of this introductory stuff. Let's jump into HMDA. So here we go. Regulation C implements the Home Mortgage Disclosure Act, which is commonly referred to as HMDA, or the acronym HMDA. You'll notice that there is no U in HMDA, which some of you may chuckle at, but no kidding. We often see it spelled that way. So HMDA 101, there is no U. In addition to that spelling lesson, over the next few slides, we've listed 11 broad areas of data that the Fed or the FDIC called out as areas with frequent violations. Some of these will apply to all reporters, and others will apply only to full reporters. Recall that under HMDA, if you originated less than 500 closed-end or less than 500 open-end mortgage loans in each of the 2 previous calendar years, then you're eligible for a partial exemption under HMDA for that loan type and can report details on a smaller data set. Word to the wise, from time to time, we do still come across someone who's not taking advantage of the partial exemption. There is enough that you have to deal with that there's no need to make more work for yourself than is necessary. And in most situations, I'd advise taking advantage of a break like this. So both the reporting thresholds and the partial exemption thresholds are applied separately to closed and open-end loans. So you can exempt, partially exempt, or be a full reporter for closed-end loans. You can also be exempt, partially exempt, or a full reporter for open-end loans. And your status for one loan type has absolutely no impact on your status for the other loan type. And this brings us to our first poll of the day. For this first poll, we're just getting a flavor for the makeup of the participants. If you're a repeat visitor to our webinars, you may also recall that we choose a winner from the participants at each poll to receive a Starbucks gift card. So please participate in each poll. There'll be 3 of them, and increase your odds of winning a Choco Mocha Latte Frappuccino or whatever your favorite treat happens to be. I think I covered most of them there. So we're asking, are you a full reporter for at least one loan type? Are you lucky enough not to be a full reporter for anything, but are a partial reporter for at least one category? Or are you the luckiest of all and you don't need to know how to spell HMDA? Who cares if there's a U in it or not? If this is you, hang in there. We'll be on to something new in a few minutes. And it looks like most of you, it's a pretty even split, aren't a reporter at all. So hopefully we'll fly through HMDA so you all don't lose too much interest too quickly. But there's a pretty even split between all 3 of those categories. So thanks to everyone who participated in that. All right, on to the next slide. So first on the list is going to be the ULI or ULI, the Universal Loan Identifier. To be honest, this is not a problem that we come across often, but the Fed listed the inclusion of personally identifiable information in the ULI. In particular, they mentioned partially redacted names. So I guess the lesson here is be sure not to include any PII in the ULI. And that means no partially redacted names, no birthdays, no social security numbers, no nothing like that. So next up is the application date. Here they listed a couple of issues. First, when multiple applications were in file, something other than the date on the first application was reported. Oh no, this can get confusing. Perhaps that first application wasn't truly an application under HMDA. If you have an application form that didn't count as an application, then be sure the file is clearly documented as to why you're using that later date. And be sure to be consistent, so that all similar situations are handled the same. Good to be consistent in HMDA. The other issue with application dates was confusion between pre-qualifications and pre-approvals. No matter what you call it at your bank or credit union, you can call it whatever you want, but Regulation C has a very specific definition for pre-approvals. You have to have a program under which all underwriting on the applicant has been completed, and that includes verifications. You've issued a written commitment to loan up to a certain amount for a designated period of time and with limited conditions. And we're not going to get into the details of those conditions today. If you're interested in that, give us a holler and we can discuss. But again, this has to be under a program that the bank or the credit union has. It's not just to accommodate an every once in a while ad hoc request. Most of our clients do not have a pre-approval program. If you do, then you report those applications. If you only have a request for a pre-qualification, hey, Brad, take a quick look and let me know how much I'd probably qualify for. Those pre-qualifications are not applications under Reg C and do not go on the LAR unless and until they turn into applications. The last box on this slide, loan purpose. So again, two issues were listed. First was with multiple purpose loans. Here, there's a certain precedence that must be followed with these, and it has nothing to do with how much of the proceeds are going towards a certain purpose. If you're taking notes, and I don't know why you wouldn't be, write this down. So purchase, refinance, home improvement, other. That is the order of precedence. If you have any funds that are going for a home purchase, even if it isn't the majority of the funds, then you report it as a purchase. If you have a combination of funds for, say, refinance and home improvement, then you report it as a refinance. Again, regardless of how much is being used for each purpose. So, purchase, refinance, home improvement, other. Got it? All right. So secondly, what is a refinance code 31 versus a cash out refinance code 32? You report code 32 only if the fact that cash is being taken out impacts the way the loan is processed or impacts the loan terms. Even if you're taking out, $75,000 in cash, so refi plus 75 grand. If it does not impact how the application is processed or the terms of the loan, then report it as a normal refinancing code 31. Many of our clients only report a cash out refi for applicable secondary market loans and not for portfolio loans because there's no difference in how they underwrite or price those. All right, next up is action taken and date of action taken. And they didn't give us much detail on the specifics of these violations, but the most common error we see here involves mix-ups between denials, withdrawals, and files being closed for incompleteness. A common scenario here is, say I apply for a $100,000 loan, but the appraisal comes back and only supports a $90,000 loan. The loan officer gives me a call, explains the situation, asks if I want to proceed with a $90,000 loan, and I tell the loan officer, no thanks, just forget about it. This then gets incorrectly reported as a withdrawal because I said, just forget about it, when it should be coded as a denial because my request for a $100,000 loan was denied. In essence, the lender made a counteroffer that I did not accept. And we won't get into it now, but this has Reg B implications if an adverse action notice was not sent. The next common scenario here is that I submit an application and then I ghost you for a couple of months while you ask for additional information. You get tired of messing with me and just close the file as incomplete and report it that way. Unless you sent me a notice of incomplete application under Reg B, ECOA, then you should not report Code 5 file closed for incompleteness. Speaking of ECOA, you should have sent me something, a denial, a notice of incompleteness, something along those lines. If not, we've also got some Reg B implications that we won't get into today. For census tract, the Fed listed errors due to recording the incorrect code. Okay. So we see this when multiple properties are involved and information is not consistently entered for one property. For instance, address, occupancy, property type, and the like are entered for one property, and the census tract is entered for a different property in a different census tract. With HMDA, consistency is king. They also talked about entering a specific census tract when NA should have been reported, and input errors, which if you're still doing that manually, then that's everyone's bugaboo. Good to have those second reviews to identify those kind of errors. All right, what's next? Gross annual income, borrower information. All right. For this one, they discussed reporting a numeric value instead of NA for a bank employee and not using the gross annual income relied upon when making the credit decision. So if you exclude certain income from underwriting, let's say a bonus, be sure not to include that in the reported amount. We also see instances where a numeric value is reported instead of NA when there's a non-natural person applicant, a trust, a partnership, an LLC. If that's your applicant, then your income should be reported as NA. Finally, co-applicant demographic information. So the old dog in me still wants to call this GMI. But when there is no co-applicant, we commonly see the codes reported for NA rather than the codes for no co-applicant. There's two separate sets of codes. For age, we often see the note date rather than the application date used to calculate the age. Sometimes that doesn't matter, sometimes it does. Or we see the birth year subtracted from the application year, which results in an error if the birthday has not yet occurred in the application year. All right, next slide. And I think this is the last one for HMDA, and I think we can make it quick. Loan term. The main error we see here is reporting the amortization term rather than the loan term when the loan is not fully amortizing. Report the loan term, not the amortization term. DTI. So that this goes hand in hand with gross annual income. If you get that wrong, then the DTI will likely be wrong as well. On the nitpicky, maybe I should say technical side, we sometimes see a ratio that's reported on the LAR carried to a different number of decimal places than the ratio on the underwriting sheet. So yes, you have to use the same number of decimal places. Number of dwelling units. Take a look at the appraisal. When we see a problem here, often the LAR reports a different number than the appraisal. If you disagree with the appraisal, that should be noted somewhere in the file, and you probably also need to discuss this with the appraiser. Loan amount. Errors here are most common in applications that do not result in an origination. Let's go back to the example where I requested a loan for $100,000 and the appraisal only supported $90,000. You counteroffer for 90 and I do not accept. What do you report? 90 or 100? Give it some thought, get your answer. All right, if you said 100, you're correct. You report the amount originally applied for if the loan does not result in origination. Another example on loan amount is if you add fees to the loan amount and nothing in file shows that the applicant requested this. If the application does not result in origination, you go back to the original amount requested. All right, last thing up, credit score and related information. A common error here is reporting a credit score for both the applicant and the co-applicant when only one was relied on. Let's say here that my wife and I apply for a loan. She has a middle credit score of 800. Why do you think I married her? There's that and a lot of other reasons. I, on the other hand, have a middle score of 650. Why the heck did she marry me? Still trying to figure that out after all these years. But if you used the lowest middle score, then you only report my score of 650, along with the name and version of the credit scoring model that produced that score of 650. Additionally, similar to the demographic information, we'll also see the NA codes 8888 reported instead of 9999 for no co-applicant when there's not a co-applicant. And I'm pretty much out of breath, so I think that means we're done with HMDA. Next up is CRA, and that is still me, so lucky you. Community reinvestment. The violations that were listed pertain to reporting microdata, so only apply to large banks, those with roughly 1.6 billion in total assets. So if you're a small or intermediate bank, or if you're a credit union, you can take a small brain break here, but don't go far because we only have one slide for CRA, and then we'll be back with something else that applies to you. All right, so first up under CRA is loan amount. The Fed cited pulling information from the incorrect core system fields and data input errors as the common violations that they see. And, yep, that can happen. Another common error that we see here is that the loan had two action dates in the same reporting year, and then the same dollars are incorrectly reported twice. So let's say you make me a $100,000 loan in February. I just love those $100,000 loans. Business is great, and I want to expand. So I come back in November to refinance the loan, and you lend me an extra $25,000. Thank you very much. Do not report $100,000 in February and $125,000 in November. You only report the new money at the time of refinance or renewal when it occurs in the same reporting year. Or you can combine it and just report one transaction. If, however, the refi or the renewal occurs in a different reporting year, that is when you report the full amount for the subsequent transaction. So if I didn't come back in until next February, then you could report $100,000 in February of 2025 and $125,000 in February of 2026. So I hope that makes sense. Census tract. The violations cited by the Fed here included reporting the residential address of the business owner rather than where the business's main office was or where the loan proceeds were applied. And that's something that we come across as well. They also listed improper geocoding by software and again, manual input error. So again, that's where those second reviews come in handy. Not a lot of detail was given for the incorrect revenue code, but what we often see is the inappropriate exclusion or inclusion of affiliate revenue. If you relied on affiliate revenue when underwriting the loan, then it should probably be included. If you did not rely on affiliate revenue when underwriting the loan, then it likely should not be included. The final bullet point on this page then for incorrect inclusions or omissions. So this one wasn't listed by the agencies, but is something that we often encounter, so I thought we'd throw it in. The definitions of small business and small farm loans are based on call report codes. What we find is that the loan has been assigned an incorrect call report code, so it was included when it should not have been, or was omitted when it should have been included. And it's abrupt, I guess, but that's pretty much all I have for CRA. So I will turn things over to Sadie to discuss truth in lending. You ready to go, Sadie?
I'm ready to roll.
Excellent. It's all yours.
Thanks, Brad. Good morning, everyone. Again, I'm Sadie Carrera, Compliance Manager with Anders. And I'm going to continue with these common violations, beginning with everybody's favorite, truth in lending. The FDIC noted in their July 2025 edition of their supervisory highlights, the violations in these three areas shown on the slide represented 21% of all violations cited in 2024. So those are pertaining to open-end periodic statements. We're going to talk about the balance computation method and the disclosures of those fees when we pay them out of the initial advance. We're going to talk about the loan estimate, some timing and fee disclosure, as well as the closing disclosure, the loan calculations, and closing cost details. I'll break these down in the next few slides for you. We're going to start out here with the open-end periodic statements, and particularly the balance computation method. Now, the balance computation method is the calculation that's used to compute the balance upon which the finance charge or interest is figured. There are numerous model clauses in Appendix G for both HELOCs and plans other than home equity plans. There are different methods such as average daily balance method and daily balance method. There's a whole bunch of them in there. And they differ on what's included in a computation. For example, your method could state that the fees and unpaid finance charges are first subtracted from the balance before we calculate interest. Or the most common we see is that the method states that any new purchases or advances are added. The most important part of this section is to remember whichever method we use, it must be consistent. It must be consistent throughout the credit agreement to the method that's disclosed on the periodic statement. That's typically located on the back of the statement paper, that stock paper. And then we have to make sure that's consistent with our bank's actual practice. If we are going to say that on our credit agreement that we're going to first subtract fees and unpaid finance charges from the balance before we calculate interest, we need to make sure that our actual core system can do that and that it's consistent with the bank's actual practice. Moving on to the disclosure of fees that we pay from the initial advance. Now, this has long been a tricky issue. We know that. There are specific rules for HELOCs and specific rules for not home secured plans. The requirements of disclosing interest, the finance charges, other costs, it all differs slightly from HELOCs to not home secured plans. Now, the FDIC specified that the violations for the open-end periodic statements actually pertain to Section 1026.7B, which is specific to not home secured plans. However, I felt it was kind of important if we just give you the variations of both. So I'm going to start with not home secured plans. For not home secured plans, finance charges attributable to periodic interest must be disclosed using the term interest charged. And the total of finance charges attributable to periodic interest must be disclosed using the term total interest. Any charges imposed on the plan other than charges attributable to periodic interest must be grouped together under the heading fees and must be separately itemized. Now, you'll see this is a common practice. We're going to talk about separately itemized a few times during all these disclosures. And remember, the total charges must be disclosed using the term fees for the statement period as well as the entire calendar date period. If we move on to HELOCs, for HELOCs, any finance charges paid from that initial advance, such as maybe an origination fee or a loan fee, again, must be separately itemized on the periodic statement and disclosed using the term finance charges. And these amounts that we're paying out of the initial advance for our origination fee or loan fee should also be included in the total finance charges that's disclosed on that statement. Now, other charges paid in connection with closing costs from the initial advance, such as maybe an appraisal fee or title commitment, should again be separately itemized and include the label closing costs or settlement costs. And that just depends on which term you used on your initial disclosures for these items. We have to be consistent with that terminology. That brings us to the loan estimate, which we commonly refer to as the LE. And we're going to start with the timing of LEs. The timing for LEs is kind of still an issue we're seeing during our reviews. They're not being provided in a timely manner. Now, some examiners take that approach that an untimely provision of an LE is the same as us not providing an LE at all. And as we know, that could be very costly, since the lack of an LE means that no costs can be charged to the consumer at consummation, because we didn't give them any estimated costs to begin with. The LE must be provided within 3 business days of receipt of those 6 pieces of triggering information. Now, Truth in Lending throws us for a loop, and there's 2 definitions of business day in there. For this section of the regulation, a business day means a day on which the creditor's offices are open to the public for carrying on substantially all of its business functions. This means for some of your institutions, Saturday would be a business day, and some will not count Saturday as a business day for the provision of the LE. And let's just recap those 6 pieces of triggering information. We're talking about the applicant's name, income, social security number, that's to obtain the credit report, the property address, estimated property value, and the loan amount sought. One thing we need to remember is that we're not going to purposely withhold any of this triggering information to delay the provision of that LE. Sometimes we see that the estimated property value is being withheld. It's not in the system. The loan officer's purposely not entering it for some reason. But really, property value is something that's readily available and very easily obtainable from knowledge from the county websites or Zillow. Even our borrowers are putting that value on the application. So just make sure we're not delaying any provision of the LE by withholding something that's easily obtainable. Now, if we move on to disclosure of fees for the LE, we have to always remember when we talk about the disclosure of fees, we have to think good faith requirement, right? It's pushed down our throats. Good faith requirement just simply means we disclose what is reasonably known to us at the time we issue the LE. So for an example, if we know we're going to have 2 different collateral properties, then we need to disclose the cost for 2 different flood determinations. Or if we know that taxes are going to be due at closing or payable within 60 days of closing per the rule, we must disclose that tax amount that's reasonably known to us to be due on our LE. Additionally, we need to be sure to, again, separately itemize all services and fees. So if it's reasonably known that we'll have an appraisal in the very beginning, right? Maybe we know the home isn't finished yet. We're doing a new construction. It's going to be done by the time we close, and we're going to need a final inspection at the end. We need to disclose those services separately, an appraisal fee and a final inspection fee. We do not want to lump those together underneath one big category, appraisal fee. They are separate services. And of course, if something extraordinary happens during the processing of the loan and we have a valid change of circumstance, we can redisclose the fees to the extent they're affected by that change of circumstance, and we get to reset our tolerances. Now, we just need to be sure when we do this that we, 1, document the change of circumstance, 2, document the extent to which any fee was affected, and then we can redisclose adding or increasing that fee affected by the change of circumstance. Of course, the same timing will apply here. We have 3 business days from the date we receive the information sufficient to establish the valid change of circumstance to issue that revised LE. Now we're going to move on to the closing disclosure, where again, we typically refer to that as the CD. Now, FDIC brought up loan calculations and closing cost details. So the loan calculations are all those calculations that listed on page 5 of the CD. So that's going to be the total of payments, finance charge, amount financed, the APR, and the total interest percentage, or the TIP. When we think of these loan calculations, we really need to start testing our systems just to make sure those calculations include everything it's supposed to and they're accurate to avoid any violations and potential regulatory reimbursements. 3 of those 5 categories up there actually have some tolerances to them. For example, the total of payments may not be understated by more than $100, And as we all know, if any of our finance charge or APR is understated outside the allowed tolerances, that could potentially trigger a regulatory reimbursement. Closing cost details. So with regard to the closing cost details, we need to be sure to disclose the amounts based on the actual costs to the extent that they're reasonably known to us. But again, as creditors, we do have a due diligence to perform to actually try to acquire those actual costs. Each fee or service, again, must be separately itemized, and we need to disclose the correct payees on the CDs. Now, on purchase transactions, we have to remember we may not omit the seller's charges in connection with the seller's portion of that transaction. The rule doesn't allow for the omission of these costs and services from the buyer's CD. So when we get that seller's CD from the title company, eventually, right? When we get that seller's CD, we look at the total costs on the seller's CD, and that should match the total of the seller paid column in the CD that we provide to our buyer. Now, I know one of the most aggravating things among all creditors, and believe me, every creditor deals with this, is trying to obtain that seller's transaction costs from the title companies. Many times, by the time we have to provide the CD, the title company doesn't have the seller's costs yet, and it's kind of out of our hands. However, what we can do is perform the due diligence in obtaining the information from the title company. Get them on the phone, email them, requesting that information, and then we got to document in our files our attempt to obtain that information. That's very important. Now, even if the title company doesn't have that information yet, we should still disclose those reasonably known items to us, such as commissions or prorated taxes, since those are pretty easy, common things that we know. We know the commissions is going to be a 3% split, at least in our market area. It may be different in your market area, depending on where you are, but in the St. Louis market area, it's typically a 3% split. And then we can also calculate our prorated taxes based upon the tax amount and the day we close. So that brings us to flood insurance. And if we move right along to flood insurance, the FDIC has noted in their July 2025 edition of the supervisory highlights that violations in these two areas on the slide represented a whopping 45% out of all flood insurance related violations cited in 2024. So those are the written notice of special flood hazard area and, of course, having adequate flood insurance coverage. Let's take a deeper dive on the next few slides. The notice of special flood hazard area must be provided to the borrower a reasonable amount of time prior to any Meyer event. Now, 10 days is the reasonable amount of time that's given to us as an example under the rule. However, the rule also explains to us that the time given should allow enough time for our borrower to obtain adequate flood insurance. So on a refi, it is typically not really frowned upon if the notice is provided a little shy of that 10-day expectation when the borrower is already aware that their property lies in a special flood hazard area and they already have adequate flood insurance in place. Now, just to recap what some Meyer events are, we're talking any origination, any increase in balance, a renewal of the loan, or an extension of the maturity date. So any one of those four events will trigger the provision of the notice of special flood hazard area. Now we can move on to adequate flood insurance. As long as I can remember, adequate flood insurance has been a hot topic among examiners. It's kind of a sink or swim concern. Yes, that pun was intended, but I'm not a very good jokester. I think maybe I should just leave those dad jokes up to Brad, or maybe even Josh probably has some better ones, but I'll try. So on this topic, either you have enough coverage or you don't. There is no wiggle room or allowed tolerances on this portion of the rule. We have to remember that the minimum required amount of coverage is the lesser of either the outstanding balance of the loan, the cost value or insurable value of the property, or the maximum under the National Flood Insurance Program. And one of the most common errors we come across when we're reviewing our items is a lack of flood insurance coverage for contents. Creditors just struggle with knowing how much coverage to require. Now, the lesser of the three will still apply to contents coverage. And typically, the value of our contents coverage is less than the outstanding balance of the loan, which really leaves us just to figure out what's the value of our contents. So sometimes our lenders are nice enough to actually include that in our write-up or our approval. But if they don't, we could probably ask the appraiser, see if they can associate a value to that contents. Or even we can look to the hazard insurance policy to determine how much coverage maybe that policy has for contents, if they have any. So once we know the value of the contents, then we can determine the lesser of the three. Seems pretty simple, right? Moving on to detached structures, many times creditors will just forget to document the use of a detached shed or garage that's located on a residential property because we think, oh, it's on a residential property. This detached structure doesn't need a separate flood insurance policy or a separate flood insurance coverage, which is true, but only if the detached structure is used for a personal or residential use, such as maybe storing your private lawnmower or your personal tools. However, when a detached structure is used for a business purpose, such as maybe they're using the garage to perform some auto body work overflow from their auto body shop, that's their main job, their main source of income, that would require a separate flood insurance coverage on that building or that structure. Additionally, any structure on a non-residential property, such as a farm, that's going to require separate flood insurance coverage. And remember, that is without regard to the value or condition of that structure. And let's talk about structure. A structure is defined under the rule as a building with 2 or more rigid walls, a fully secured roof, and that structure needs to be permanently affixed to the foundation. All right, guess what that brings us to? It's poll time. Our second poll and our second chance for you to win a Starbucks gift card. So here's the question. At consummation, the detached structure was used for personal use. Now the loan is renewing. Do we need to reassess the use of this structure? So we have the answers here. Yes, we have no, or I don't care because my lender said that garage has no value. So let's see. It's looking like yes is winning. We have no once or twice. Nobody doesn't care. Oh, you guys got some great lenders. They're not telling you the value. The structure doesn't have any value. That's great. That's wonderful. All right. So it looks like yes is won with 98% of you. So if you answered yes, 98% of you are correct. We need to reassess and document the use of the detached structure on any residential property prior to a Meyer event. Good job. Thank you so much for participating also in that poll. That's going to bring us to our next slide, and we are going to talk about credit reporting disputes. Now, the most prevalent consumer complaints in 2024 pertain to credit reporting disputes. Brad mentioned that earlier in his portion. In fact, 18% of consumer complaints in 2024 pertain to credit reporting disputes. And again, the FDIC notes that in their July 2025 edition of their supervisory highlights. Either the lack of a response from creditors, an incorrect response, or an untimely response was the biggest concern. The accuracy and integrity of information furnished to credit reporting agencies has always been a struggle. I mean, we have lack of training, we have lack of guidance on the procedures that should be taken. So as of late, eOscar's been doing a really good job and has some great tools published on their website to help us navigate properly how to run reports, how to respond to direct notifications, as well as responding to block notifications. Yet it still lacks the information on how to accurately report information to the bureaus and how to accurately respond to disputes that we're receiving, through eOscar. Now, our systems still use the Metro 2 format. Our core systems use that format to report the information to the bureaus. And really, the most helpful guide that we have to navigate this world is the Credit Reporting Resource Guide. Now, this guide's available to reporters, of course, for a fee. Nothing's free. And it's published by the Consumer Data Industry Association. This guide is full of instructions that will give you the resources needed to accurately report the information through your core system. It even goes into detail on all kinds of tricky little situations and how to report all of that information. Accounts like when they're included in bankruptcy or maybe charge-off accounts, repossession, foreclosure. It gives us all of that good information. Now, lastly, I want to talk about another important concept before I pass things over to Josh. It's the concept that we see that is just still not widely being performed, and it's very important. And it has to do with internally random sampling of information. So what I'm talking about here is you obtain some soft pull reports or some audit pulls of consumer reports, and you review the information that we as financial institutions furnish to the bureaus and make sure that that's being interpreted accurately. And then ultimately that's reporting or spitting that picture out on the borrower's credit reports. So since Metro 2 format is like a hairy beast of codes, it's our responsibility as furnishers to be sure the bureaus are taking what we tell them and accurately, again, portraying that picture and reporting that on our borrower's credit reports. So it's a very good idea. Definitely start pulling some audit reports, soft pulls. We see even credit reports that you're already using, but we want to get a good sampling of different counts and different derogatory status. So, make sure you're getting some HELOCs, make sure you're getting some auto loans. We want to make sure that we're doing all of that and really making sure that we sample that information we're reporting. So on that note, I am going to pass the mic to Josh so he can tell us some more about the violations on the deposit side. Josh, are you ready? The floor is all yours.
All right. Thank you, Sadie. All right. Again, I'm Josh Labadie. I help manage our BSA and deposit operations work that we perform. I'm going to start here by talking about Regulation E and specifically to Reg E, error resolution procedures under Section 1005.11. And then after this, I'll talk about the delivery and content of truth and savings disclosures before handing things off to Brad to take us home. All right, so for your dispute investigations here, we'll recap what is defined as an error and therefore protected under Reg E. And then we'll walk through the various timing and documentation requirements of the error resolution process from the original customer dispute all the way through the notice of final determination. And then I'll talk about what are among the most common exceptions that we come across. All right, so practically speaking, the definition of an error, and if we can go to the next slide there, please. Thank you. So yeah, practically speaking, the definition of an error is broad and covers pretty much all electronic transfers. So any transfer of funds initiated through an electronic terminal, phone, computer, or magnetic tape for the purpose of ordering, instructing, or authorizing a financial institution to debit or credit an account. So this is your point of sale debit card transactions, ATM transfers, direct deposits and withdrawals, phone transfers, P2P, and mobile payments. In terms of what actually constitutes an error, so we have unauthorized listed here. I'll come back to that in a second. You have an incorrect transfer. That's an amount different than was supposed to be transferred. The lack of an EFT to or from an account. A computational or bookkeeping error made by the financial institution. A customer's receipt of an incorrect amount from a terminal, and an unauthorized terminal withdrawal. So in terms of unauthorized, what does unauthorized mean? So it sounds simple, and for the most part it is. There's a little bit of nuance. An unauthorized EFT is an EFT from a customer's account initiated by someone other than the customer without authority to do the transfer, and from which the customer receives no benefit. All right, so if my wife gives me her debit card and asks me to run to the store to get something for her, she authorized that, even though she didn't make the purchase herself. All right, If I take her debit card out of her wallet and go buy myself something, that's unauthorized. If a transfer is conducted by means of fraud, robbery, or force, that's unauthorized. And then finally, there's the question of customer negligence. You may not consider a customer's negligence when determining liability, and this is something we kind of run into. This is expressly written in the regulation, and probably the most common example of that we would see is if a customer writes their PIN on their debit card. You're still obligated to accept those disputes and investigate with that knowledge. All right, so the initial notice of the customer's dispute. The dispute must be received within 60 days from when the institution sent the periodic statement reflecting the transaction, and then the notice should indicate why the customer believes an error occurred. You're obligated to begin investigating upon receiving either a verbal or written notice. You can require written notice within 10 business days after the verbal if you want, but your timer still starts at the verbal. All right. The difference is you don't have to give provisional credit if you require written and the customer does not provide it. All right, so here's a cheat sheet of all timing requirements under error resolution. I'll run through these real quick. 10 business days from the date of dispute to either make a decision or give provisional credit. That goes up to 20 business days if the transfer was made within 30 days after the first deposit to the accounts. That's typically your new accounts. If you give provisional credit, you have 2 business days to notify the customer of that, either verbally or in writing is fine. You notify the customer of the date and amount of credit and give the customer full use of the funds while you investigate. If you need more than the 10 days and you gave provisional credit, you get 45 calendar days to complete the investigation, and that's extended to 90 if the transfer was not initiated within a state, was a point of sale debit card transaction, or occurred within 30 days after the first deposit to the account occurred. So again, new accounts. And point of sale debit card, that's emphasized there because that's one that we all know and love the most. And then finally, you must notify the customer the results of the investigation within 3 business days. Okay, so the investigation will end one of 2 ways. Either you'll find in favor of the customer or you will not. Your obligations are less stringent if you do find in favor of the customer, either because you recover the funds or you did not and you choose to eat it. If an error did occur, notify the customer within 3 days and let them know the credit is final. This is verbal or written, either way is fine. Just make sure the credit isn't mistakenly clawed back, especially if you have a lot of people touching those disputes. If no error occurred or an error occurred differently than the customer originally alleged, either because your card processor determined it was authorized, your own investigation determined this, the merchant refunded, or the transaction never ended up posting, notify the customer in writing of the date and amount debited. And then you have to include the language on the slide here that you will honor checks, drafts, or similar instruments payable to third parties and pre-authorized transfers from the consumer's account for 5 business days. We do see that language missing sometimes, so be sure that that's included. You have no further obligations if the customer comes back to dispute the same transaction, so no double jeopardy here, assuming that they don't ask for documentation supporting the investigation or want more information or clarification, which you would then need to be prepared to support. All right. Okay, so since there's a lot of particulars with error resolution procedures, I wanted to briefly walk through it before I talked about some of the more reoccurring findings that we come across during our reviews. So overall, 47%, so about half of the FDIC's Reg E findings in 2024 fell under error resolution. Sometimes the provisional credit isn't given within the required 10 days, and this seems to happen either because it's a manual process and it just gets missed, or the institution is relying on a third party to help manage the workflow, and there's a breakdown somewhere in that process. Inaccuracies on the hold notice or delays in getting it to the customer. There's a lot of room for errors on your letters. It has to reflect the right amount of credit given and taken, the correct date that it was given and taken. It has to include the required language that talks about honoring third-party transactions and the right to request documentation, and all that on top of getting it sent out on time. So various errors on the notice itself are something we see. Some of you are using software to help track your disputes, which, that certainly takes the guesswork out of some of it, but there is still a lot of room for error there. This last bullet here, the basis for denial. We run into this maybe a little more than we used to. It's not extremely common, but it's something you should be thinking about because of reputational risk or potential legal exposure. Since the customer has the right to request documentation if you deny, if your investigation was, flimsy or unsubstantiated, or you base the decision on customer negligence, maybe, you potentially have a gap. All right. Again, negligence is not a basis for denial. The regulation is also very protective of the customer in the sense that you cannot obligate the customer to, say, file a police report or try to settle with the merchant before you'll investigate. Just keep that in mind. All right, I'm now going to shift over to truth and savings here. I'm going to do this one in reverse and talk about the most common exceptions first. And if we can jump to the next slide, thank you. What you're looking at here are where more than 2/3 of all TIS violations that the FDIC found fell under in 2024. So quite a bit here. The most common issues among institutions that had TIS violations traced back to the failure to provide accurate disclosures, specifically the sections in the Code of Federal Regulations that you see here. So the first part there, US Code 4303 and 4305, and the CFR 1030.3, that's what requires you to give accurate disclosures, clearly and conspicuously, everybody's favorite words, in writing. And then CFR 1030.4, that dictates the specific requirements of the disclosures, such as accurate interest rate, balance computation, fees, etc., which we'll run through now. All right, so your general disclosure requirements. So again, clear and conspicuous, in writing, in a form the customer can keep. If you satisfy e-sign, they can be electronic, and you may give them to just one person on the account. And then this is the part of the reg that also dictates the accuracy of the interest rate in APY. So when we review, we do recalculate your interest in APY on statements and disclosures, and then we trace what the disclosure said to the statement for consistency. All right. Disclose it to at least 2 decimal places, and then you get a tolerance or plus or minus 0.05% for rounding. So your disclosure said they'll get 1.25%. They should actually earn between 1.20 and 1.30 in the statement cycle. Okay, delivery at the time of account opening, and then on the next slide we'll talk about upon request. Give the disclosures before the account is opened, and when the customer is sitting there, or if not then, before you provide a service. So, which the reg says a service has been provided when a fee required to be disclosed is assessed. If the customer is not sitting there for some reason, mail or deliver the disclosures no later than 10 business days. And then for online account opening, the customer has to receive them before the account is opened. Okay, so if the customer walks in and says, I'm just browsing and isn't opening an account, there are a few content requirements that are in addition to the ones that we're about to talk about in the next slides. The requirement to provide the disclosure upon request is triggered at the moment the customer specifically asks for written information, all right? So if they're chit-chatting at the teller window and they ask what the rates are these days, that does not trigger your requirement. The material must include the elements listed here. Interest in APY, accurate within 7 days. Accurate as of X date. Your phone number, institution's phone number. And then maturity must be presented as a term date rather than an actual date. So say 12 months instead of the date of maturity. Okay, moving on to specific content requirements. It needs the correct interest rate and annual percentage yield using that term, not APY. So fortunately, this presentation is not subject to Reg DD because it's going to keep saying APY. And then for variable rate accounts specifically, you need these things here. A statement that the interest rate and APY may change, how the interest rate is determined, the frequency at which the rate may change, and then any limitation on the amount that the rate can change, if any. Compounding and crediting of interest. So compounding is referring to how often the accrued interest is added to the account balance. And then crediting is how often the interest is actually made available to the customer. They don't have to be the same. Usually we see monthly or quarterly for either. Daily compounding and monthly crediting is common. This is important to disclose accurately in the sense that your customer needs to be made aware of when they'll have access to funds, that interest that they've generated. So, make sure that your disclosures, your advertisements, and your system processes are in alignment. If the customer closes the account before interest that has been compounding and accruing is credited, will they forfeit that interest? If yes, you must disclose. Otherwise, an omission of the fact is fine. All right, balance information. The first bullet here, this is simple enough. Any minimum balance required to either open the account, to avoid fees, and to obtain the APY. And fees here, this is simply referring to minimum balance fees, such as a $5 monthly fee if the balance falls below $500. So nothing to do here with overdraft fees, NSF, or ATM withdrawals, for example. The balance computation method, either daily balance or average daily balance. So pretty self-explanatory. Using daily balance, interest is calculated each day on the actual balance in the account. So the balance is $500 on Monday and $1,000 on Tuesday. It's calculated separately for each day. Average daily balance, you can probably figure out, uses the average of the balances each day during the statement period. And then when interest begins to accrue on non-cash deposits, typically we see the same day as the deposit. You can also disclose business cutoff time if you want and apply that as well here. All right, other fees. List each specific fee and the amount. So you have account maintenance fees or fees for opening or closing the account, transaction fees like excess withdrawals over a certain number, minimum balance fees, NSF, and then other special fees that are specifically mentioned in the reg, such as stop payment, balance inquiries, or deposit verification. Now, something we do run into in our reviews that relates to fees for overdrawing an account. You have to specify the categories of transactions that can incur an overdraft fee. This is standard language that sometimes just gets forgotten on the disclosure. You don't have to list every single one, but the standard language is to say that the fee applies to overdrafts, and this is from the reg, created by check, in-person withdrawal, ATM withdrawal, or other electronic means. So listing that you charge $35 for an overdraft and leaving it at that does not suffice. All right. Transaction limitations. So any limits on the number of checks written off the account in a given period, and limits on transactions during the life of a time account. And then bonuses. These are uncommon, but we do see them in the wild sometimes. So any amount of a bonus, when it will be provided, and then the minimum balance and time requirements to get it. So sometimes we'll see something like receive a $50 bonus for having 3 direct deposits of at least $500 each within 90 days of account opening, and the $50 bonus will be credited within 30 days of meeting the requirements. All right, so it's my last slide, and it's specific to time deposits. Excuse me. This is in addition to anything that we just talked about for deposit accounts. So you need the maturity date, a statement that a penalty will or may be imposed for early withdrawal, and you don't have to use the word penalty if you don't want. That's just what the reg calls it. How it's calculated and the conditions for imposing it. If interest is compounded during the term and can be withdrawn before maturity, state that the APY calculation assumes all interest remains on the deposit until maturity, and that a withdrawal will reduce earnings. All right, and then finally, whether or not the account will renew automatically, and if not, whether interest will be paid after maturity if the customer does not renew. And then if it will renew automatically, give the grace period. Okay, and that is what I have for you. That falls under deposit operations. I'm going to hand it back to Brad to close us out.
All right.
Thanks, everyone.
Well, thank you, Sadie. Thank you, Josh. Job well done on both counts. So we'll wrap things up with identity theft, which was not one of the top cited violations of either the Fed or the FDIC, but complaints related to identity theft were in the top 3 for both agencies, with fraud and forgery coming in at number 2 for the Fed, and accounts opened without knowledge coming in at number 3 for the FDIC. So not saying that all fraud, forgery, and unauthorized account opening is ID theft, but a good chunk of it will be. Next slide, there we go. So at the bottom of this slide are the various types of identifying information that, if used in that fraud, would be considered identity theft if it related to a covered account. And this list is not exhaustive. It's pretty good, but it's not exhaustive. Only so much room on the slide. But look at the second bullet point under identifying information that deals with biometric data. One thing I've been thinking about lately is that, how might AI impact this? With all the deep fakes, the ability to take a photo, a video clip, audio clip, and mimic someone and mimic them pretty dang good. How might that factor into identity theft in the coming years, if not months, if it's not already here today? That to me is scary. I think it's time to beef up those ID theft fraud systems, as soon as we can. But to hit on a couple of common errors we see. One is excluding EFT disputes that Josh just talked about from identity theft reports. Again, not saying that all EFT errors are identity theft, but a good chunk of them probably are. Other common errors we see deal with the risk assessment, and that's one, having incorrect opening and access methods for a particular type of account. Two, linking red flags to account types that just frankly don't make sense. And then three, having assigned risk levels that, again, don't make sense or just are not supported. I mentioned beefing up those identity theft programs. We're seeing more and more of our clients use an automated system to identify fraud, oftentimes in conjunction with AML software. And we have heard from one of our clients that the amount of additional fraud they're able to stop by using the software pretty much covered the cost of the software. That's wonderful. That's great. But the sad part of it is that's probably not the norm. More often than not, we see clients pay a lot for this software and then not fully utilize it, so to not end up reaping the benefits that this one client has. So you got to put all that upfront cost, dedicate the resources to it as well. And I know we're a little over, so we'll wrap up the prepared comments with that. Have one final poll. As usual, we'll end by asking what topics you'd like to see covered at future webinars. This is a word cloud, so be brief, and the more common topics will appear larger. This can be anything you want. BSA, 1071. Yes, it's probably coming back. TRID, IT, taxes, you name it, and we'll cover it. I see BSA popping up. Josh, that's you, buddy. So this is your last chance to win a Starbucks gift card, and we'll be announcing the lucky winners shortly. So be sure to submit your ideas and hang with us until the end. So looks like we're getting some good responses here. BSA, TRID, so that's Josh and Sadie. Excellent. Good to see everybody participating. We'll give you just a second more to do that. But speaking of future webinars, we do already have the next one planned. And once this poll closes, we'll jump to that slide. And this one might not apply to a lot of your all's day-to-day work, but feel free to snap the QR code on that next slide. There we go. All right. Sorry, I forced you to close the poll there. But you can snap that QR code, forward it on to your CEO, CFO, controller, whoever handles taxes at your institution. We'll have a couple of our tax experts, which is definitely not me. That's going to be more Brent and Rebecca. They'll explain the tax implications of the one big beautiful bill, particularly for financial institutions. So if you didn't get that QR code snapped, it wasn't working. It'll be in the slides that we send out with a follow-up email. And you can always look under events on our website, which is www.anderscpa, all smashed together, anderscpa.com. So I think next we have our contact information. Here's Josh's information. If you want to reach out directly to him, he's a good resource for all things BSA and deposit ops compliance. Here is Sadie's contact information, and she is a good resource for anything related to loan compliance. That includes HMDA, Fair Lending, TRID, flood insurance, you name it, and she's your go-to for loan compliance. And then next will be my contact information. I'm always happy to talk about anything related to the banking industry, sports, outdoors, you name it. But you can snap this QR code and it will go straight to my booking app if you'd like to schedule a time to talk, especially if it's about anything on the next slide. And this is a listing of the banking related services that we offer. Not included here are financial statement audits, tax services, of course. As a CPA firm, we offer those. And not only for banks and credit unions, but for many other industries. So if you have customers or members in need of tax or audit services, please let us know. We'd love to talk to them. I guess a couple of other things that might be of interest that aren't included here, that we have a wealth management arm. So if you would like some assistance with that individually, or if your bank or credit union is looking for help in setting up or managing its retirement plan, Claris can help with that. In our advisory group, we have several skilled virtual CFOs. If you have a customer or member who is growing to the point where they could use the strategic thinking of a CFO, but aren't to the point where they can afford a full-time CFO, this service is tailored to them. If you got a customer or member who needs a SOC audit, we have experts in that as well. So enough with a shameless marketing plug. We're here if you need us, and we're always happy to talk. And this is the last slide. I think the only thing we have left to do is announce the winners of the Starbucks gift card. So Minna, if you could shoot me the winner of the third one, that would be great. If I call your name, please send me an email so that we can get that e-gift card out to you. My email is bstumpe, B-S-T-U-M-P-E at anderscpa.com. The winner for the first poll on HMDA reporting status is Carrie Livingstone. So congratulations, Carrie. The winner of the second poll, which was more like a quiz on flood insurance, thank you very much, Sadie, is Manel Cycles. So Manel, I hope you got that one right. And then I'm still waiting to see the winner of the third poll. And again, if I called your name, so Carrie and Manel, email me at bstumpy@anderscpa.com, and we'll get that gift card out to you in the coming days. I guess for the winner of the third one, I'll just shoot it. Oh, here it comes. I see her typing now. Drum roll, please. And it's Heather Yoker. So Heather, thanks for your idea on the future webinars. So the congratulations to our three winners. Enjoy your Starbucks treat. Shoot me an email, bstumpy@anderscpa.com, and we'll get that out to you. So everyone, sorry we went a little longer than we thought we might, but thank you so much for taking time out of your day to spend an hour and 14 minutes with us. We surely appreciate it and hope to see you next time. So bye now.